Good morning, members. We welcome you all on a Sunday morning on a tax seasons on a very important topics. Today we have kept the topics wherein we are not going to discuss the provisions line by line, but we have converted all the important provisions into the case studies, and today's very eminent speaker, CA Kinjal Bhuta, we have invited. We welcome you, madam, on a Sunday morning with a round of applause. So before we discuss it further or before we formally introduce her, I would request all the members to please rise for the Institute motto song.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 पुरुषो निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनाद्यपि कश्चन एतद्द्वैता
I will play the national anthem.
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मागे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
Thank you very much. As we are discussing that the ignorance of law is not an excuse, and while doing the tax compliance of the taxpayers, any of the mistake, it is prone to the litigations. So on this premise, today we thought when we are discussing the topic with the today's speaker, we needed something wherein instead of covering all the important provisions on line by line basis, we thought have a kind of case studies wherein indirectly we can cover all the important issues related to today's topic. And accordingly, Madam has put his best efforts while compiling all those case studies, and hopefully it will be helpful to all the members and the taxpayers at large. So with this, now to have the formal introductions of the today's speaker, CA Kinjal Bhuta, I would like to invite our own member, and our core group member CA Hemant Gandhi ji to formally introduce our today's first speaker, CA Kinjal Bhuta. Hemant bhai, please.
Good morning, friends. Our convener, Sri Jayesh Bhai, has already welcomed our today's learned speaker, CA Kinjal Bhutta ji. So we are very thankful to her for sparing her valuable time and to come and give her wisdom and expertise on this other subject. About her, she is having a working experience of 10 years plus in the fields of direct and international tax. She has her own boutique tax firm and specializes in litigation and transfer pricing. She has worked previously in KPMG in financial services, private equity taxation, and Messrs. A.J. Shah and Company Chartered Accountants. She is a managing committee member of Bombay Chartered Accountants Society and core group committee member of direct taxation and convener of seminar and membership development of BCS. She has authorized publications on Practical Guide to Faceless Assessment and Appeals by Bloomsbury Publication and Presumptive Taxation under Section 44AD, 44ADA, and 44AE by BCS. Editor of BCS Referencer and annual flagship publication of BCA. She is faculty on direct taxes on post-qualification certificate course on drafting of deeds and documents, pleading and representation by ICAI. Kinjal contributes various articles to tax journals like BCS and Chamber of Tax Consultant, and she is a regular speaker at various platforms of professional importance at the ICAI. So now, before inviting her, I request CA Vinayak Khambateji to present a memento to CA Kinjal.
So yes, good morning, a very good morning to each one of you. I'm so used to presenting in Zoom lectures, so I was trying to find my face in this. But then I realized that I'm making a presentation physical one, and I'm excited to do that because it is after a lot of, I think, a couple of years that at least this is my first presentation which I'll be giving physical post-COVID. So very excited to be present here on a Sunday morning. And I I'm very ecstatic to see so many people turning up, especially in the return filing season, considering that the topic is a little swayed away from return filing. But today's topic is interesting for the reason I had to specifically make each of the slides and not copy paste from my earlier presentations. So at least to that extent, it is very different. As we had discussed earlier, that we are not going to discuss any legal provisions today. So the only thing which I have tried to cover is the legal case studies, or tried to create certain fictional case studies also, just to have an overview. Uh, I have a lot of learned members in the audience, so I'm here to learn, and let us make it more interactive, because since it's case studies, it doesn't make sense if it's a monologue and I keep speaking. So if you have any queries in between, I'll be very happy to take them. We can discuss other issues too. So yes, let me start without wasting much time. So presentation is divided just basically into two parts: capital gains case studies and presumptive. I have tried to have, since this topic can go on for, I think, days together, it's that deep as a topic. So it was very difficult for me to choose case studies, but I have tried to restrict myself to those kind of issues which one might crop up in filing the returns of income. So try to restrict myself towards that. So yes, the first case study is here. So let me explain you in brief what is the scenario here. So Mr. B has sold one residential property in financial year 21-22, and he had purchased this property under construction in financial year 16-17. So the property which has been sold is different from this under construction property. And he already had purchased something in the previous year, wherein the installments, since it was under construction, he was supposed to pay installment wise. So it was paid from various years. He started from 2016, the construction delayed, and that is why he continued to keep on paying till 2023. Now the question is that if one has to claim deduction, if there is a capital gains, one has to claim a deduction on purchase or construction. So purchase is 1 year before the sale or 2 years within the sale, and construction is 3 years within the sale. So now the question here is that if Mr. B has already purchased a property under construction, so can that installment which he has paid before the period of construction, can that be claimed as an exemption under section 54 or it is residential property? So under 54, whether that can be done by the assessee or not, because the act is not very clear. It just says that construction within 3 years. So this is one of the question here, and no, I'll put it open to the floor. Any answers to this? Any guesses that what could be the situation? Because in a standard typical situation, once you receive, that is how it happens normally. People have capital gains, they receive the sale consideration, they reinvest that sale consideration into some other property. But I'm an assessee who had money beforehand, and I had already purchased something before. So can Mr. B claim deduction under section 54? It is different property. Yes. Yes. For example, say that what was purchased was somewhere in 1980s, and that is the property which has been sold in the financial year 21-22. This is a complete different property which is purchased by him under construction, not with an intention to reinvest, obviously, because sales was subsequently done. But because of the delay, he continued to pay. So now it's a very legitimate query that, and a very practical one, which has happened in many of the clients, that they purchase something and it staggers, and then, you don't have money to again purchase into some other property. So let me, mention this to, firstly, let me mention the circular which I've mentioned here, which is circular number 359. This is a very old circular, and this circular is with respect to the erstwhile section of 54 EC, which is 54E, wherein you had to invest your sale consideration within 6 months into some bonds. So this circular specifically it was a clarificatory circular which mentioned that if you are uh, doing any investment into some capital bonds, even if you are doing certain investments before you are selling, because the clarification was brought about because when it comes to real estate transactions, they are not clean black and white, right? You might get into a deal today that you have to sell, but then probably it might get delayed. You are into an agreement of sale and then probably you do a sale deed after 2 years. There could be multiple scenarios of how a capital gain transaction can happen. So the certainty of the date of the transaction is not something which is known, and that is the reason they brought a clarification that even if the assessee is investing into those bonds before the sale, that should also be allowed under section 54E. Now, this is something which we can specifically use for these sections because they are all sister sections forming part of the same deduction. But there are two cases which are I would not say identical issue, but probably similar issues in Allahabad High Court and Karnataka High Court. So what had happened in these cases was that the assessee in a similar situation had paid for an under construction property, and the assessing, it was obviously it went into litigation and it was not allowed, and the main ground of the assessing officer was that only, that since 54 says that you have to reinvest your proceeds out of sale consideration, this is something which was not your intention. Your sale proceeds are still lying, which you have already sold. The plea of the assessee was that I'm still continuing to pay installments. I'm going to continue pay till 2023. So it is very obvious that I'm going to use certain sale proceeds out of this and I'm going to pay for that property. So at the end of the day, both the cases were in the favor of the assessee, and it stated that one has to go, and I think this has been throughout when it comes to deductions under section 54, 54F or G or EC, that those have to be seen with the intention with which the provision has been introduced. So if the idea is that you are not using the amount to something else, you are reinvesting, there is a quid pro quo, there is a property in place of another property. So this is the intention when it comes to deduction under section 54 and 54F. And since the assessee has reinvested or has already purchased some another property, the deduction should be very well given. In fact, in one of the case, I think I've mentioned the Karnataka High Court cases in case of J.R. Subramaniam. In this case, the purchase of property was 7 years before the sale, the purchase of the new property. And since it got delayed, the construction completed only after the sale. So suppose consider an example that this property has been sold in February 22. So in that particular case, the construction of the purchase property completed in March 22. So they did keep on paying the installments, and not only the one year before. That was also another angle which I want to discuss here, because these sections says that whenever you are making a purchase prior to the sale, it's 1 year, the limit is 1 year. So the AO said then, right, what will happen is that 1 year, whatever installment you've paid before this sale of this property in financial 21-22, I'll allow you that much. These cases went against that too and said that the entire amount which has been paid towards purchase has to be allowed, irrespective, because the section nowhere specifies that the construction has to begin only after you make a sale. Construction can start before also, you can start paying before also. The only thing which is I think silently brought about in one of the cases is that the construction should not have completed before you sell. So suppose if I'm selling a property in February 22 and I've paid for an under construction property and it got completed somewhere in January 22 and that is completed, then it doesn't make sense, because then it is already an event which has been already completed. But if it is continuing and the construction is going on, then in that case the entire amount which you have paid should be allowable. So this is one of the beneficial, probably case studies which could be used. Now, another rider which I have added here is that, will the answer change if the assessee has already claimed a deduction on the said property few years back? So twisting it a little further, that this property which I had purchased, under construction in 1617, and I had multiple properties. So I had claimed a deduction under section 54 once before also in respect of this property. So let me bring certain numbers to clarify. Now, if this under construction of property has been purchased for around 5 crores, 2 crores amount I've already claimed as a deduction for some earlier property which I have sold in the earlier years, because this property is ranging from 1617 to 23. So now can you claim that deduction? Yes, definitely. So what will happen is you will have to obviously restrict, you cannot take deduction of the amount which you have already taken. But if it is 5 crores and you have already taken utilized 2, then for the balance 3, you can definitely claim it. So the thing is that because section nowhere specifies that the purchase which you are making has to be restricted to claim the deduction only once. Nowhere it is also specified that you could claim deduction under 54 or 54F only once for the same property. So you can still continue to do that. And just adding one thing regarding capital gains account scheme here. So can certain amount be deposited in the capital gain account scheme and the amount paid in the year 23 be considered as utilization towards the purchase of new property? So now the question here is that the amount which you have already received on the sale, whether you could, since you have already claimed the deduction or probably a part of deduction here, consider that you have sold a property for around 2 crores and you have only 1.5 crores which you have from the earlier property which you have purchased. You still want to claim another 50 lakhs. So can that amount, you can now deposit it to the capital gains account scheme, and whatever installment which you are supposed to pay for this property under construction, you pay with, you make that payment from that capital gains account scheme, then whether you can claim that also as a deduction. I think the answer to this is also clearly yes, for the reason that at the end of the day, it all boils down that I'm using the money for the purpose of purchasing a capital asset. So when that is the scenario, whether it is an under construction property of before, whether it is a disputed property which you have, never paid, it could be, especially such cases helps in those cases wherein, there are properties which you have purchased quite a few years back under construction and which are stuck up. And now that probably the regulatory formalities are clear and it has started working and you have started paying installments towards that, or you are paying the final amount for taking the possession of the property. Even those disputed properties purchase which you are making, you can make that amount from the amount deposited into the capital gains account scheme, and you can very well claim that deduction. And I think the last question is that what will be the scenario if Mr. B claims the deduction, however, does not deposit in the capital gains account scheme? So now we all know that, whenever there is a sale, if before the return filing, which is the original due date of the return filing under 139(1), if you have not deposited, if you have not made a purchase, then you have to deposit the amount which you want to claim as a deduction in the capital gains account scheme. And then you have to use that amount within the limit of that 2 years or 3 years period. So in this case, the assessee did make the purchase within 2 years, but it did not, deposit this amount in the capital gains account scheme. So now the question is, this is a procedural formality which was required as per law. This was a mandatory requirement as per the section. In such a scenario, can at a later stage assessing officer says that, look, you did made a purchase, you did made a purchase under construction property, but you did not put or deposit the amount in the capital gains account scheme within the limit of 139(1) or 139(4), which is the belated, because there are many case laws. I have not touched upon that. It is, I think, a well settled law that even if you deposit in the capital gains account scheme in the extended due date, which is the belated return filing due date, you still can claim exemption. So here the question is, will the AO allow this rationale? if correct. So that is why I could not get many other case laws, but this is a very good one, direct one on Madras High Court. And in this scenario, they have allowed it. They have said that, see, capital gains account scheme is a requirement, but at the end of the day, it is a procedural formality. So if it had been a scenario that he did not deposit in the capital gains account scheme and neither he utilize the proceeds towards the purchase or construction of the property, then in that case, very well, obviously you cannot claim the deduction. But in a case he did that, he did not put it in the capital gains account scheme, then only because of that procedural formality you cannot abstain an assessee from not getting from not giving a deduction under section 54. So a very good decision, and in fact in many of the practical cases it does happen that the assessee doesn't know. No, now every day most of the people, they file the returns on their own, so they just claim the deduction and they think it's done, and they are not aware that they have to invest the proceeds before the return filing in the capital gains account scheme. So if that is happening, because many a times which I have seen is that if the duration of the return filing is gone, even if the assessee realizes at a later stage that he has to put it into the capital gains account scheme, there are banks who do not allow that. That as per income tax, now you get certain formalities from the income tax officer, get a stamp that you have delayed your deposit into the capital gains account scheme. So even if you realize a mistake later on, probably the bank doesn't allow you, and in such kind of a scenario, this probably decision could help the assessee. So yeah, any questions pertaining to this case study? Yes. Yes. Hmm.
April 2018, right?
Correct.
So that will end on 2000. Makes a payment in April 2020. April 2021.
See, there are umpteen number of case laws where in a similar situation they have allowed the deduction. So I do not have those presently written out here, but I do have it in my research and I can probably give you. The reason is that the uncertainty always prevails in under construction properties, and it doesn't work out that clearly like 2 years and 3 years, which is specified in the Income Tax Act. The only thing is if you utilize the amount later on after 3 years, you might have to probably give it bank. That's what I'm telling you. You will have to probably meet the assessing officer. Okay.
Only problem is that this is
the question that whether the property is under construction or purchase is when you make a first purchase. So when you did it way back.
I have sold it up.
Correct.
2 years to construct and
Yes.
2 years to buy.
Once, so now I get your question and I think I'll just clarify the question for everyone's understanding also, that it is a scenario that you kept it for 3 years, considering that you will purchase a property under construction, and then you realize that 3 years are getting over, I will buy a property, and the under construction property you received the OC. As soon as the OC is received, it doesn't, could not be considered as an under construction property unless it's a part OC. If
No, I differ with that. Because the act doesn't say. Because there is no criteria that the construction is over. Still the construction. Some money, say 1 crore rupees entirely.
Okay.
So when they make the payment to the builder, so that shall.
it
not
is
applicable to the India.
correct.
So that doesn't say that if the OC is not OC.
Correct.
It's a bad service.
See, here the situation is factual. It will also depend on that. Suppose when you are making a agreement, when you are making this
The
purchase,
nature is the bad service.
whether you are receiving the possession immediately or no, because it then you can very well see, if there is certain civil construction, there is two things in that. One is that you have to do something in your flat which is remaining, and second is that they themselves as a builder might be doing certain flooring or grilling or property. So if it is beautification of your own house, then it is so if you do not fall into that parameter, and there is certain, if it is not a habitual, I would say, if it is not a habitual purchase, then it is still under construction. And coming to another thing, I will also going one step further. There has been situations wherein you are supposed to pay, because what happens is you make the, in many of the cases, what happens is if the litigation if there is a construction which has been delayed and it is into litigation, you might hold the substantial payment towards the end. So in many cases I have seen wherein it has happened that there is just a simple letter of allotment, you have paid no consideration whatsoever, and you make it towards the end and you receive a possession. In those cases also, they have gone beyond that 2 years limit to 3 years, and they say that because it's very difficult to streamline it into two baskets. Correct. Exactly. So if you have those documentations in place that this is the reason why, I think you can definitely claim it. It might turn up into litigation, but and now that we have the new reopening sections, we have everything which can happen under the roof. But yes, but it could be allowed. So yes. So you had something. Yes.
What is the date to be considered for the reinvestment in the under?
It's 3 years.
3 years, but
From
agreement date, or because there is
Hmm.
after paying 15%, the party is entered into the agreement.
Purchase agreement you're talking. Okay.
And subsequently, they have what will be the current calculations for the exemption date I'm talking about?
For exemption, the purchase agreement date is not relevant. What is relevant is the sale date for which you are claiming the deduction. So the sale date which you have made, the act says very clearly it is within 2 years of that date. So you will have to count, if you want to legitimately count the 3 years, it will be from the date of the sale of that property on which you are claiming the deduction in the 54 or 54F. I got.
Yes, it will be every account scheme. And if you keep on making payment for that particular
It will be allowed. Yes.
And if the amount is not deposited, then
That is what I heard, that if it is not deposited, so obviously one should not make that as a practice or a habitual thing, because it's at the end of the day, obviously a high court decision which you can use of. But yes, there are scenarios where they do allow you to, but one thing is sure, it will not get allowed at the earlier stage, at the assessment or the CIT appeal, or probably even the ITAT stage, they might not allow you. But because at the end of the day, ITAT is the last fact-finding authority. So only after that they go beyond on the beneficial provisions and all those things. So it will be allowed at a later stage.
This 2016 payments are also allowed in this case.
Yes.
And the date of sale is the date of agreement or registration or what? Within 3 years or before?
That is exactly, I think, his question probably, that date of
Date of sale is considering 2 years and 3 years
this is the date of sale which you're asking
for the sold property.
for the sold property. So see, I have tried to cover that in the another case study. I'll come back to you. But I have covered a proper case study on when it should be considered as a transfer. So when we come to that, I'll definitely come into. Only to the extent of capital gains which you are.
More than capital gain.
Yes, yes. Just move on. So again, there are a lot of case studies regarding deductions, because there will be a lot of other provisions which I'll try to discuss here. So there is one residential property which is amounting to rupees 50 lakhs. The assessee has done 2 sales during the year. One is of a residential house and another is a long-term capital asset, which is certain mutual funds, which is amounting to 60 lakhs. Now, within 6 months, the assessee purchased property amounting to rupees 2 crores. Can he claim exemption under section 54 for the residential property sold and exemption under section 54F? Now, 54 is that you sell a residential property, you purchase a residential property, and 54F is that you sell a long-term capital asset, but you have to purchase a residential property. So both the sections have one thing in common, that you have to purchase a residential property to claim the deduction. So whether it will be allowed, I think I heard many yeses, and the answer is yes. This has been unfortunately litigated in number of cases, and hence I have provided all the cases here. Most of these cases have been settled at the ITAT level. It didn't had a need to travel to the High Court, because first, there is no bar in the section which says that you cannot claim deduction under 2 sections in the same assessment year. So in all of these cases, the plea of the assessing officer was one single thing, that you cannot claim deduction under 54, 54F, or probably even 54 EC. You cannot claim everything together in 1 year. However, it has been held that there is no bar in the act. And since there is no bar, even if you use the same property for 2 different deductions, you can still claim the deduction, because there is nowhere written that you have to purchase individual properties. Another interesting element was, at that time we had a requirement in these sections that you need to have only 1 residential property with you. If you have more than 1, then you can't claim the deduction. So that was also which they interjected, that if what assessing officer is telling has to be executed, then in that case the assessee will land up in 2 residential properties, and then he will totally be outside the ambit of these deductions, and that is not the intention of the law. So yes, very well you can claim. In fact, there have been cases wherein they have claimed under 54, 54F, and also the remaining amount they have deposited into bonds for 54 EC, and even that amount has been allowed. So this is a very simplicity, just to clear the concepts. Yes, now this is regarding, I've taken this typical kind of it's a fictional case study, wherein how one can calculate cost of acquisition or cost of improvement, and what is the elements of cost of acquisition and cost of improvement. Now, Mr. C had sold a long-term capital asset in financial year 22, and that property and he had also purchased the property in the year 1986. Think if there's a mistake, he's not sold a long-term capital asset, it's a property only. It's the same property which I'm talking about, which is there in 1986. So he's sold this property. The initial purchase of this property was in 1986, and there was a redevelopment in 2001. So in the redevelopment, in a classic redevelopment, you get certain additional units. Probably if a 2-bedroom flat gets converted into a 3-bedroom, as compared to the builder gives in part of the additional FSI which is available on account of redevelopment. So he got an additional 200 square feet of area along with his existing area of property in 2001 when the redevelopment agreement was entered into. Now, in between, he had made certain legal costs towards the redevelopment in the same year. We all know that redevelopment procedures have a lot of litigation involved. So there was litigation cost also. The society as a whole had litigated, and this particular individual also had litigated and had certain legal cost involved here. Legal cost will also involve here the cost which the assessee would have paid to a lawyer for referring this redevelopment matter, that whether I should get into this redevelopment or not. It is not only about the litigation, because many times you have to refer to an advisor to see to it that whether the redevelopment agreement is properly drafted or not. So this is that legal cost also. The assessee also purchased some additional area. Now, as a existing tenant of the flat, you get an option to purchase additional area too. And he purchased an additional area when the property was under construction, and around 300 square feet of area was purchased in 2003, which is when the construction was going on. And so these are different cost areas where he has put in money. In the year 2005, he did interiors in the property when he received the possession. Now, I'll get into the part that what are the interiors, but to be specific, these are the interiors which he had to put in to make the house livable, which I had earlier discussed. Like probably you have to put up a grill so that to protect from invaders, or probably you have to put up a door or a second door or a lock system. So this is all that kind of interiors which was done as soon as when he received the possession. And in 2007, the assessee does certain civil work in the house. So there was certain civil, why I'm mentioning civil work is that it is not work towards the beautification of house. It is not that I want to change the color of the house, or probably I want to change certain closet system. It's a civil work which is being done. Now in this case, how the cost of acquisition or improvement will be worked, and how the indexation will be taken for calculation of capital gains in financial year 21-22. So here, I straight away give certain simple answers which I have it in mind, and you might bring in certain points here or certain rejoinders here. So first, obviously, the sale consideration which is there, you take that when you make a computation. Now, when it comes to that, this is a sale of a property which is received by you under redevelopment. So first question, and very simple question, do you take the cost of 1986 here? I'm asking is, although this is very simple question, but I have known many of them who take the original cost, and there are people who take it under even 49(1) saying cost of the original owner. So what happens is, there are two areas wherein what happens in case of a redevelopment. To be very simple, because this is a topic on its own, but to be very simple, when it happens in a redevelopment thing is that whenever you are giving away your right to redevelop a building as a tenant, you are extinguishing your right in the property, and there is a capital gain which strikes when you get into a redevelopment agreement. Your old house goes away, you get a new house, you get a new agreement for that. There is a redevelopment agreement also. So 1986 cost has already gone, and it has been taken in computation when you calculated capital gains when redevelopment had happened. Now, then the question is, what is the cost in this case? Yes. See, what happens is by default under redevelopment, what happens is the classic provision of these deductions come into place, because what happens is when at one stage there is extinguishment of your rights as a redeveloper.
Another property.
Correct.
Not lost any right.
Correct.
According to it, that's the reason there is no capital address in redevelopment.
So then in this case, I just would like to have your views that for sale of this property, which you have got it in exchange of your earlier property, what is the cost which you will consider?
You are telling for the ownership, replaced by ownership property.
Yeah, so my flat would also.
Rented property.
But it specifically says that if there is a development, then when the OC has been received, so there is no provision.
Those,
Yes.
yes, and those provisions are with respect, specifically with respect to these two scenarios. One is redevelopment and second is joint development. So,
Correct, correct. So what I
correct. And the sale here is in financial year 21-22. So the provisions which have been brought about, they might not be with respect to, they are not retrospective in that respect, but whatever transactions which have been concluded for that respect, these provisions will definitely apply. But I would get one, what he specifically mentioned is regarding the stamp duty valuation. So the cost which is being here will be on account of redevelopment. Now here also, I would be wrong in saying if I give a very perfect answer that what would be the cost, because there is a lot of litigation involved. First thing is that because this is a gray area, and that is why we have a lot of pending cases still. But one of the common view which I could probably read between the lines is that that is the valuation which you do as on the redevelopment. That is the amount which is to be considered as the cost of this new property now which you have received in exchange of the earlier property which was there. So this is one aspect when it comes to the cost part of probably claiming the capital gains. But I would like to move on to the other things which he has, because at the end of the day, when he's selling the additional 200 square feet, is additional 300 square feet also. But there the answer is very simple. So now when you're getting the additional 200 square feet, that is something which is an additional right which you are getting on account of redevelopment at par with all other. That is a ratio which is decided based on the existing square feet which you have in the property. So that goes into the valuation part in the cost itself. But the additional 300 which he is purchasing, that has to be considered as a different cost element, and the indexation will have to be done from that year in which the purchase has been made. So that will be towards the cost, and that will be a cost only and not a cost of improvement or something like that, because there is no improvement here. This is just for the academic distinction between the cost of acquisition and improvement. However, when we compute the capital gains, it really doesn't make a difference because indexation is allowed on both, on cost of acquisition and improvement both. So the year of indexation will be determined in the year in which the purchase has been made. Now, when it comes to two things which I have specified, is one is the interior works and the civil work. And here, I would like to specify is that when we bring about interior works, which I'm talking about, which is during the possession. So as I have mentioned that, in fact, I've brought about in another case study of mine when we're calculating the cost of acquisition and improvement, that all those interiors which you are doing for making the house habitable, which is absolutely essential for living purposes, that will be considered as part of the cost. However, if there is certain other interiors which you are doing for beautification, then in that case, you will probably have to bifurcate your cost between two parts, and then accordingly, you will have to add it into cost of acquisition and cost of improvement. The another part is that when there is civil work which is being done, so now it is not necessary, because there has been queries in the past that when you do a civil work, it means that you are probably, you know, making a new wall, or probably you are changing the false ceiling which requires civil work, or probably you're changing the entire flooring of the house. So here it's very specifically one has to see into the facts of the case. There is no, because I have mentioned very generic civil work here, but what one has to see, it's based on the facts of each case, that what kind of civil work it is done. Not necessary that just because it is a civil work and you are touching the structure of the house, that it is considered to be part of your cost of improvement. Cost of improvement will only include that kind of a civil work, which is, suppose if there is something, some damage which has been made, there is floods and your floors have completely damaged, and you do a civil work, that is different. But suppose I feel that, you know, I have this 2 bedroom and I want to convert it into 3, whether that kind of civil work, that is just to make your house more comfortable to live into, and more about the choice, and that is the work which is not something which is considered in a specific cost of improvement. What is a cost of improvement is nowhere defined, and that is why you know, there are various scenarios and case laws wherein they have discussed multiple scenarios that what could be a cost of improvement. But again, I'll go back to the same, that it will completely depend on the facts of each case. So that is how one has to do it. And in the year in which it can be established that it is a cost of improvement, you will have to probably claim the indexation in that particular year, and then make it part of your computation of capital gains. So yes. So here, this particular case study is basically just a very specific one, but it is basically related to the expenditure which one has to, one can take in calculation of capital gains. So it's a very interesting one and a practical one, and I'll take some time to explain. So Miss D, who owned a parcel of land with other siblings. So there was a huge, consider that it was around 10 hectares of land, and it was a parcel of land which was inherited from the father by the siblings. So Miss D was one of the sibling of that, and since it is a parcel of land and a huge land, normally it happens a lot of time that it is sold in a fragmented way. You do not, because it's a huge parcel, you do not sell it at once. So that is exactly what had happened here, that what they did is they sold a part. Now it was 10 hectares land to for an example, and suppose around 3 hectares of land was sold in 2002 to some Mr. X, and now that Mr. X got those 2 hectares of land. He's in turn sold it to some Mr. Z. However, while selling, what did he do is, there was a fraud. What he did is that instead of 2 hectares which he had purchased, he sold 4 hectares, something which was not in his limits. So this has been a practical case, and it is happened in one of our own case, because when it is a huge parcel of land, the limitations, or you know, it all depends on whatever is being put up in the Sat Bara, whether it is updated there or not, and somehow he could get into those records and bring that land into his purview. However, it was clearly something beyond which he had in his property. So he did not own that thing, but still he sold and he got money for the same. Now what happened is, the remaining 8 hectares which I had, I sold it to some Mr. Z finally in a later year. So now the question is, what happened is that there is a 2 hectare of land which has been sold twice, one by me and one by some other person fraudulently. So the question was here that the person who received the flat fraudulently, he filed FIR, he filed all possible complaints that, this is a flat which was purchased by me by giving certain money, irrespective whether that flat was in ownership of the seller or not. But I have purchased in the correct pursuit. I have got the ownership of the same, and that is why this amount, this flat is mine. So he land, sorry, that land is mine. So he claimed ownership towards that land. Now, because of this, the disputes were in the department, and both the purchasers, leaving aside the sellers, my assessee is a seller, Mrs. D, but leaving aside them, both the purchasers went into Bombay High Court claiming the ownership towards that flat. And obviously, since both the sellers were also party to this particular land, they were defendants, co-defendants, or co-plaintiffs. So here the question is basically not about ownership, but the amount which was spent towards the legal cost or the outcome of the legal suit. So finally what had happened is an out of court settlement, and wherein obviously there was a Bombay High Court suit, and which said that my assessee out of this entire settlement had to pay 4 crores, I think that's 4 crores towards this land, had to be paid by my assessee for clearing the entire title of this property and passing it over peacefully. So now the question is that all this litigation obviously takes time. By that time, I had already filed my return. I had claimed capital gains, and I had paid tax on the same. So that year was over. Immediately, the assessee, what they did is that as soon as they paid this 4 crores because of the Bombay High Court order, they claimed a revised return, and they claimed this 4 crores as an expenditure towards the sale of this property. So whether a subsequent event, this is not an expenditure which you had done during the sale or before the sale, but this was a very typical case wherein there is an expenditure subsequently which you have done, whether that can be allowed from the computation of capital gains, and that too in the revised return which you have filed. So obviously, since I was party to this particular thing, I'm aware that it went into litigation and the expenditure was not allowed, and it went into a later stage. But there are these 2 cases which are very relevant, not specific to this particular case study, but with respect to expenditure which has to be claimed under Section 48. So one is Bombay, which is Shakuntala Kantilal, and second is Lakshmi Reddy in Madras High Court. So now what did Shakuntala Kantilal say is that specifically brought about the scope of expenditure under Section 48. And so these 2 cases are otherwise relevant for anyone who would like to, probably claim certain expenditure which are not out of the box or probably something different. It clarifies the scope that Section 48 specifically mentions that any expenditure wholly and exclusively in connection of transfer of property or land. So in this case, they have determined the terminology. What do you mean by exclusively in connection with the transfer? It has specified and differentiated that the words in connection with the transfer and the words for the transfer, these 2 are 2 different things. Had the legislature written for the transfer, then the scope is very small. It says only for that particular transfer, whatever expenditure I have claimed, I can allow. But if it is in connection, is a very wide terminology which is used in the section, and that expands the scope of Section 48. And though this particular amount is a subsequent expenditure, so in both of these cases, it had happened that there was a expenditure or a legal cost which was done, or any amount which was paid as an outcome of the suit before the legal authorities was allowed. In fact, in the Madras High Court decision, they also allowed the fees paid to the advocate who was fighting the suit for the assessee. which was a subsequent event. And what had happened in this case, this particular case was, which was a very beautiful judgment of Mumbai ITAT. I have not mentioned the citation here, but finally we got this in our favor. And what they specifically mentioned is that they brought about that element that whenever there is a cost which is relevant to the title or the ownership of that particular flat. So suppose in this scenario, if I would have not considered that, we would have not come into a settlement and this litigation would have gone and I would have lost the case. In that case, my particular purchaser, the agreement would have been nullified. And if that would have been nullified, there would be no sale. There would be no transfer of title of this property. And if there is some particular cost, even subsequently, but so inextricably linked to the transfer or the title or the ownership of that particular flat, it has to be allowed. Even if the assessee would have not claimed a revised return and it could have claimed, then also it had to be allowed because it was a subsequent expenditure which he was not aware of, and that was something which he had to spend to give a clear title of the property. So this gives some clarity. Whenever if you want to claim an expenditure, we probably might have to think in our head that is this expenditure in connection with the transfer which you are making. So suppose if you are paying some legal, there are various cases where not all legal costs are allowed. So that is the reason why I'm bringing this parity, because there might be certain legal costs wherein you probably are there have been cases wherein there is dispute in the property, or you are probably trying to find out the history of the seller as a purchaser, or you're trying to find out that whether I should purchase this particular property or not. All those expenses have been not allowed in the past. So when you're talking about a sale expenditure, it has to be connected to the sale and not the purchase of the property. That also has to be looked into, because many times what one confuses is that whatever expenditure you do or execute in this particular capital gains, you can claim it, but it is not necessary. It's only related to the sale or the transfer of the property. So yes, this was regarding that particular expenditure. Now, this is one thing. There are various case laws here, but this is regarding that when you have multiple units, Mr. E sold the shares of a company and invested the gains for purchase of house and claimed exemption under 54F. The assessee had 9 other residential flats in his name. Okay, it was not jointly owned. And Mr. E stays in one of those flats, and the rest 8 flats are rented out as commercial premises, whether deduction can be allowed or not. So now the section specifically says that you need to have only one residential premises when you are claiming a deduction under section 54F. It doesn't allow you to have so many other residential properties. The assessee had this. Now, if you go strictly by the 4 corners of law and literally if you interpret the Income Tax Act, the deduction should not be allowed, because the idea of even if you go into the intention of it is that it promotes the resale of the amount or usage of residential premises towards the cost of the residential premises. In this particular case, one very interesting element which has been held by the Karnataka High Court is that not only what matters is not only that how are you holding the flat, but it also matters that what is the usage of the flat. So if you are purchasing a house and it is in a residential capacity, you are purchasing a residential house, but we all know that there are multiple commercial premises which are functioning from residential premises. There are a lot of shops. Normally when we get a OC, there is different OCs for commercial and different for residential, but practical instances that there are many offices which are functioning out of residential premises. So in such cases, do you consider your flat as a residential premise or as a commercial premise? So in this particular thing, they held that since the usage of these flats, as soon as he purchased these flats, it were put to a commercial use. And one has to also look into the usage and not only in the capacity in which it is held. And that is why the exemption was surprisingly allowed. Now, whether this is correct or not is a controversy, because there, if you take the rationale or the ratio of this judgment to some other cases, because there are cases, suppose for section 54 that allows a deduction only in case of sale of a residential flat. So I say, no, this is not a sale of residential flat because I'm putting it to use to a commercial premises. So, this goes into the very basis of the entire argument. So this seems to be like, stars favoring the assessee. That is what I would say. It definitely is an aggressive view, considering that he had all the residential flats. And in fact, we have some cases which are, held in contrary to this particular judgment, which I have covered in some other case study, which I'll touch upon. But yes, in certain extents, wherever there is a controversy, regarding the flat, many a times it happens, there are various places wherein the residential or commercial premises are used. Even there is a lot of issue when it comes to claiming of depreciation, etc. So going aside from 54 and 54F, the theory which they have used in this case laws regarding the usage of the flat really helps in some other cases, maybe probably not specifically relating to the deduction, but wherever you have to prove, or whenever there is a question which comes before you that whether this is a commercial premises or rental premise, this parity probably will help you.
Madam, here state one thing that this is not a jointly held property. So is there any difference if the property?
Yeah, there is. The next one is that. So I'll come to that. Yeah. Yes. I'll come to that too. I have taken that. Yes. Speak. Sorry, can you? I'm not able to listen half of the part. Yes.
Person
The stamp duty.
stamp duty paid.
It is the stamp duty paid for the loan agreement.
Yes, as well as support to the purchase. As well as the bank.
See,
Bank also insists.
See, when it comes to this is a very typical scenario, but my prima facie view is that it will not be allowed unless it doesn't come into the eye and it gets allowed. That is a different thing. But whatever is probably included in the cost, that is why not all the expenses which are incurred by you in purchasing, because there could be a host of expenses which could be allowed. When it is the finance cost, you are definitely getting as an interest which is reduced from your income. But when it comes to this cost, unless and until, I would say that unless and until that cost is something which is very relevant for you to purchase that property and without which you could not, that kind of expenditure normally gets capitalized to the cost. But this particular amount per se is not a capital amount which could be added. That would be my view as of now, the first view. But there would have been a lot of cases where they would have claimed, and if it would have not come into that, it would have been allowed also. Many times they do, because if it doesn't get into the parameter, or you're lucky enough to not be scrutinized, then it might be allowed.
Secondly, madam,
I'm coming to that. I've considered one of the case study. I'll try to do it in detail.
thank you.
Yeah. Oh, sorry, I already moved. This is also another one which is regarding to the cost which you can claim. So, I was coming to that there is an assessee who is a non-resident and received a property by way of an inheritance. And this is very much, common these days, that the ancestors were in India, however, they have received the properties for non-residents, and they had to pay legal charges towards obtaining the probate from High Court. There were also certain foreign travel expenses, because obviously you have to come to India to do all those things. So they spend a lot of foreign travel, multiple foreign travels. And so these were two expenses. Another one was that there are certain expenses for vacating the tenants which were there, which were not, probably vacating the property, and you had to, so that you could sell it in turn. So whether all of these or any of these expenses can be considered as a part of the cost and could be indexed together, or it should be considered as an expenditure, or it should be considered as a cost of improvement. So now, when it comes to the legal charges for the probate, now probate is something which is, this is not something which he has mentioned is regarding the processing of loan or something like that, but this is again something which is very relevant to obtain the title of the property. And if I would have not got a probate from the High Court, the property would not have been transferred, the title would not have been transferred, and this is an expenditure which is basically, I would not even say an expenditure, but it is something, an amount or a cost which you have incurred to get this property in your name, and that is why it should be rightly be added to your cost, because it is towards getting the title. If you would have not incurred this cost, you would have not received the property, as simple as that. So that is why it has to be added to the cost. It has been rightly held by Bombay High Court decisions too, that probate cost has to be added to the cost. What about the legal expenses? Now, first is the travel expenses. Now, whether the travel expenses, will you consider it as a part of cost, or whether you will consider it as an expenditure? Because when you compute capital gains, the expenditure is allowed only with respect to transfer. Right now, you are obtaining a property. You are not transferring the property. So whether the legal cost for purchase of property will be allowed or not, in this particular case, they have allowed it to be added to the cost of the asset, saying that it would be impossible to do the probate formalities sitting in a foreign country. And as you consider probate is important, then obviously anything which requires the presence of the assessee for the probate is also extremely important. It was a scenario when the client or the assessee was overseas, he had to fly it down. So that particular cost was also allowed on this parameters, that it was very much related to obtain the probate, which in turn was necessary to get the title of the property. And that is why it was one typical case where it was allowed. And another thing is that if there are certain legal expenses which have been done, so apart from these, whether that will be allowed or not. So according to me, that is something which might not be allowed, which is towards the cost of the property. However, there have been cases. So one of the case thing which I've mentioned here is in the last one, which is Bombay High Court decision, wherein they had it was a very interesting situation, wherein what they told is that since you are having the cost for removal of tenants, or you are removing the encumbrance in the property, you are making the house probably, if there is a house which has tenants and you sell it, such kind of houses are also being sold wherein there is an age old tenant. However, we all know that the value of the property is reduced. Suppose if you might, the fair market value of that property might be around 2 crores, but you might have to, take a cut of 10-20% because you have old dwellers in that. So this particular Bombay High Court said that if there are certain hutment dwellers, or if there is anything nearby which you are removing, you are giving them money to, make your property more worthy, you are increasing the value of the property in turn. And when you are doing that, it is nothing but cost of improvement, because what you're doing is you are enhancing the value or the marketable or the sellable value of the property, and that is why it has to be allowed as cost of improvement. So I have specified that decisions which could probably help in those cases where you are removing certain encumbrances. It is not necessary the tenants, there could be certain other things too. But if it is enhancing the value of the property, then probably you should consider it as a part of cost of improvement. So yes, this is a subject in its own, and it has a lot of controversies, but I thought it would be incomplete if I don't touch upon. So the idea is only to touch this, because otherwise I'll take up Aditya's time too. So when a transfer is considered, or transfer is defined under section 247. So we know this basic parameters, we know sale, extinguishment, exchange, or part performance under section 53A of Transfer of Property Act. These are four, five limbs of the definition of transfer. But here what I have specified, whether it is for the claiming of deductions, or whether it is for indexation, or whether it is the year in which you will offer the capital gains for taxation. A classic case would be wherein I am an assessee who have gotten into an agreement. Let us take an under construction property. There is a letter of allotment, the first thing which is received by me, wherein I give certain, shagun, which is like 5 lakh, 10 lakhs or something like that. And there is this letter of allotment which is signed that I own the right over this property and I'm going to purchase, and these are the installments or the way it is going to work out. And it might propel the date of possession or the date of ownership. So that is one agreement which is brought about. Not in every case, but in many cases, there is a letter of allotment. That is the first agreement. Second is consideration. Now, there could be various ways in which consideration could be paid. It could be like 20/80, or it could be like you are paying. There have been cases where the assessee has outrightly purchased, an under construction property. It used to happen in the past. Now with RERA, it has reduced. But it used to happen that you are making a substantial payment of consideration and only a token is left to be given when the transfer or the agreement has been made for sale. So that is the second thing, when the substantial consideration has been paid or full consideration is paid. The third is when you make agreement to sell. So there is a difference, I think we all know, between the sale deed and the agreement to sale, or the conveyance and agreement to sale. Agreement to sale, as the word says, is not a sale deed. It is just the parameters or terms and conditions which brings about that both the parties are agreeing to sell this property at this particular date. Or there are certain cases where agreement to sale is also registered. So there are certain cases when what happens is, I'll tell you a very practical and a typical example of a person who is purchasing a property on a housing loan. So what happens is, when you are taking a loan, it's not that when you're taking a loan, you'll get the loan proceeds immediately the second day. It takes processing time. And what happens is that you are making part payment out of your own funds, part payment is out of the property. And the assessee the seller wants to sell the property and get it done. So in that particular situation, how do you legalize this transaction? You enter into an agreement for sale, wherein you say that these are the particulars. 50 lakhs is loan, 50 lakhs is own funds, which is paid outright. Loan, as soon as it gets reimbursed, it gets directly debited or directly get credited to the account of the seller. So this is the agreement to sale. And you might even pay registration charges or stamp duty at that particular time. Either you can do that, or you can defer it when the sale deed is made. In many cases, I have seen that once an agreement for sale is done, there is no sale deed made, because if you do everything there, you take signatures, you mention the consideration, and you pay stamp duty, then that is considered as a locked deal and you don't do anything. Obviously, it is advisable to have a sale deed or a conveyance deed, because at the end of the day, agreement to sale is just an agreement. It is not the transfer of conveyance. So in many cases where people know about it, they also get into another agreement later on when the amount has been disbursed by the bank, that this is the final conveyance. It is also many times called as conveyance deed, wherein you probably just pay that 100 rupees stamp duty paper and you do it, because stamp duty you have already paid earlier. And if you don't pay it earlier, it also is a trouble, because then, they will get it in your 26 years that you have already sold the property but not paid stamp duty, you have not deducted tax at source. So normally what they do is they pay it when the sale consideration or when the agreement for sale is done. So now there are these different scenarios when one should consider it as a transfer. That is the question. There, I'll tell you, there are cases where the transfer is considered when possession is received. Okay, that I forgot, when the possession is received. There are cases when you don't pay full consideration, yet you receive possession. The case which he's mentioned, there are cases when you don't receive OC, but you still receive the possession. So there are certain cases like that. And we have high court level decisions when the transfer is considered at the possession level, transfer is considered when the substantial payment has been made, transfer is also considered when letter of allotment has been signed, and even when the sale deed has been signed. So what does this say is, this slide is not to basically conclude anything, it is to confuse everyone. So, but given that, it is definitely something which explains us that it is completely dependent upon the facts of each case. But certain parameters, I think, out of reading out of many case laws, so the case laws which I've cited here are in favor of that particular case. One might read it. I do not want to discuss those case laws here, but there are certain cases like the epic decision of Jasveer Singh Karkaria, or we have Kantila, or we have Chaturbhuj Dwarkadas. We have certain cases which have laid down certain parameters that when can you be considered as transfer. So one thing is that which one has to understand is that whenever the title of the property or the ownership of the property is considered to be transferred, that is something which is considered to be transferred. So suppose if it is a scenario where I have received a silent possession or complete possession of the flat, and if I have not paid a single money for that, then it will not be considered as transfer, because there is no consideration which has been paid. For a contract to be considered to be a contract, there has to be a consideration. So only getting a possession, I might have got forceful possession. Is that a transfer? That is not a transfer, because I have not paid any consideration towards that. So at the end of the day, most of the scenarios should work together. If there is a single case where there is only possession, no consideration, it is not transfer. There could be a reverse situation where I have paid full consideration, but I have received no possession. There it could be a transfer, because I'm giving away and showing my intention to purchase the property. Otherwise, why would I pay the full consideration towards that? Many a times what happens is, in a under construction property, I might pay full consideration and I never receive the property. In those cases, it has been considered in the there are two cases when it comes to people fighting in the civil court. They say that I have paid the consideration, I have the title towards the property. But the moment those same people, they sell that whatever amount which they have paid and they sell the right in that property, they say it is not transfer because I never received the possession or title. I just paid the consideration. So, there are two faces when you argue that. But what will come to my mind is that when you are giving away the entire amount, you are getting some rights, if not all the rights. You might not receive the possession, you might not receive the final thing, but you might receive certain rights. And under capital asset, the right which you receive towards the capital asset is also a capital asset. So a capital asset should not be only construed in that four corners of the building or the flat or land, but it could also be the right which you have to resell that. That is the reason many people resell under construction properties too, when you have not received that. Even in case of a letter of allotment, there have been cases when a letter of allotment, where half of the consideration is paid, the property is under construction, only the plinth area has been started, but that has been considered as transfer because they have certain riders in their agreement which has an irrevocable powers to the person who is entering into a letter of allotment. So that is like not going any back, you have to get it. So in such scenarios, they have considered letter of allotment also as a transfer. And that is the reason, the good part is you have cases everywhere. So you have to find a case, and you want to see that what is favoring you, and then you have a case for that. So the good part of the litigation is that you have, and the good part is also that you have regional decisions. There are decisions wherein Bombay High Court is saying something, Karnataka High Court is saying completely opposite to that. So one can, probably turn and twist the case laws and use it accordingly. But the basic parameter I would say in each of this is the title or the ownership, that whether if you have some right, then you will have to consider it as a transfer. So the decisions which I have kept given here are landmark decisions, which probably could help in getting into insights that when you should consider it as a transfer. Yes.
For example, if I purchased under construction property 5 years back, I receive the possession now and I sell it within. Can I take the benefit of section 54? But then the AO sometimes said, selling within 1 year, it's a short term because you receive the possession.
They say everything. Let them say. That is their habit. So they say everything, but you can definitely claim it. Yes.
Only part payments and 20% or 10% was paid at the time booking and purchase under construction property. And then I was sold within 1 year. Can it be said a long term?
So when was the agreement done? That is also.
Agreement was done before 3 years.
When you paid that 20%? Okay.
And now I'm paying 80%. And now within 1 year I'm selling it.
It will be considered as long term in this case because agreement has been, you have registered your agreement, right?
Yes.
You have paid stamp duty as on fair market value as on that day. It should be considered as because except for consideration, all parameters are getting ticked. No, your ownership you're getting the ownership because the agreement is there in your hand, and if you didn't have the agreement, you could not even sell it. So the agreement is transferring the title to you.
And suppose OC is not received and the possessor is not received.
That is also fine. There are multiple flats where OC is not. In fact, people are living in those flats where OC is not received.
Even the possessor is not received.
Then also, see, one most important element and simplest part of transfer is when the agreement is registered, because then it straight away gets into the Transfer of Property Act, and it is considered as transfer because you pay the stamp duty as on fair market value and you get the title of the property. And most importantly, the seller has no rights over that property now. So, because now he will not be able to sell that flat which he's already given to you because he's entered into an agreement with you. So his right is lost and your right is there.
So even if OC is not received, possessor is not
You
received,
still have it.
for 3 years I can sell.
You can.
Not help when you are selling the property claiming that for 1 year.
Sorry, it will.
This criteria will not help you if you have sold the property and you are claiming that for 1 year.
Yeah. Then it will not. Yes, not in that case. Yes. Yes.
I'm referring
Hmm.
20% amount 3 years back,
Okay.
80% just 1 year back, and within 1
When you are selling that property.
Yeah, when selling the property. I think only 20%.
You see, according to me, if I would be, there is two views in this definitely, because everyone is having different view here. But according to me, if I would be it, I would claim the entire indexation, because the title I'm receiving that time. So the cost has been analyzed. Everything has been set in that agreement which has been written. And it is at the end of the day, indexation also depends upon the period of holding. So I'm holding that as an asset, but you will be not happy with it, and he will say that there are cases wherein you are required to do staggered indexation, but that is only in case when the agreement is done at a later stage.
So what agreement is done first and then you pay on in staggered manner, then you take it on the that part.
No,
Deferment of payment.
to be on a very safer side, you take indexation as in when you pay. But I think one should take a try, and because at the end of the day, the title of the property you are receiving, you are owner of the property of that particular amount. There could be loan also. What in a situation if there is a loan and we are paying interest later on? You are not outrightly paying that amount of out of your own pocket. You might default the loan later on. It could happen, but that doesn't mean that you will claim indexation as and when the payment has been made. So yes. 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 Yes, yes.
Debit the full cost and get the indexation.
In return as advance. Acha, but what is the question? Like,
Question is that, where should
see,
be return?
But in return, you don't have to show the purchase. No?
No,
So
we have to show, no,
it
in
is
the-
just books of account in
In the
which.
house property, we have to show.
So you have shown it as a property which you have owned in the house property in that particular year.
Yes.
But your agreement and everything happened in the subsequent financial year.
No,
In the same financial year.
21, 20.
Okay. And only the part payment of TDS was done in the next financial year, April.
Yeah.
So there is no harm. So see, if your agreement 20 for deduction of TDS, it says that if you are not paying in lump sum and you are paying in installment, you have to do as and when. There are people who pay the entire 1% earlier also in advance when the advance is done. That is the safer side which people do. But if you want to defer it by 1 month, people, I am aware of the situation where some of it is in March and some of it is in April. But at the end of the day, you are getting the property in the financial year 2021, which is the earlier one. When you are,
It is not shown in house.
that
Is
is
it any problem?
no, unless it gets into see at the end of the day, if you will have to show it as house property as a declaration. When there are many people till date have many properties, they don't declare, and there is no problem whatsoever.
Okay.
But because of AIS and TIS and everything, they are getting to know things. But at the end of the day, the penalties are not too harsh when there is non-declaration, unless it's foreign assets. So apart from that, if you do not declare, it might be considered as an oversight, but it should not be a very big problem to you.
There is no need of revise the return.
No, don't revise for this purpose. You might probably show it in the next year.
Well, in my case, 90% of the payment, TDS is deducted this year, and sale is also made this year, then how can I claim the long-term exemption? Because of purchase TDS will come this year.
But he is not claiming, he's not selling the he's just okay in your case.
What property was purchased 6 years, 3 years.
Okay.
10% was paid. 90% of the payment is made this year, TDS is deducted. Sale is also made this year, TDS is deducted. Both are shown in the 26 years. Still I am paying.
If your sale payment TDS is, I will not consider at all for anything, because it is just a compliance. So let the TDS go away from the question. Now we are only related to the agreement and the amount. So if the agreement has been done in this year, then I know. If I'm just bifurcating, if the agreement is in this year, then obviously there is short term. But if the agreement is in the past and you are paying substantial, you still can claim it, sir. Because in fact, I've considered that in one of the case studies. Or I don't know, I probably skipped that one. Or no, but there is one of the things which one has to, and we have a lot of judicial precedents. It is not necessary that the amount which you are receiving in sale consideration should be reinvested. So you might have the amount substantially paid this year. The similar analogy will apply. So, the first case which I discussed, wherein you had purchased a property much before. So it is not necessary. The law nowhere says that whatever sale proceeds which I am receiving, I have to reinvest only that sale proceeds. I may take a loan and also I can reinvest. That could also happen. Exactly. So you do not have to correlate that head to head, that particular amount has to be considered. For the duration, you will have to see the ownership.
The SSCS is having long-term capital gain on sale of shares. Bank loan for purchase of those shares.
Sorry, can you get back?
The SSCS is having a long-term sale of shares. He
It would be, I would say, too aggressive to take, because interest is just the choice of your how you're funding that particular transaction. So that way, that way everyone could probably borrow and do capital gains and claim interest on that. It is just the choice of funds. You might use own funds, you might use borrowed funds, but then you are not allowed to use that, because then it becomes like an arbitrage. In fact, there are many cases wherein the interest rate might be higher and you might have a loss because of that, if you increase the cost to the interest. So I think it would be too aggressive to take that stand. Sorry? You want to? I don't have time. Yes. Yes. Yeah, sure. So yes. So this is the classic, I think we all have come across, and I think last case, one of the case studies which is there for capital gains is share trading or business income. And again, this slide is just for food for thought. There are a lot of controversies. Again, here we know that whether it should be considered as share trading or whether it should be considered as long term or short term. So I have tried to mention all those instructions which will help a person determine that whether you should consider it as share trading or business income. So the classic instruction which we had way back in 1989, which specified that what could be a trading asset and what could be a capital asset, and based on that you will be there. The much controversy has been put to rest with the latest circular which came up in 2016, which specifically stated that if the assessee has two portfolios, one investment and one trading portfolio, and the assessee is consistently doing transactions based on that portfolio, the assessing officer has no rights to probe into and change and shuffle and consider long term as business or consider short term as trading. So if the intention of the assessee, a lot of importance is given to the intention of the assessee, the books of account, way it has been accounted in the books, the consistency with which the assessee has been considering those shares. I cannot make one particular XYZ share as a trading share in 1 year and investment share in 1 year. So in fact, there have been cases where a assessee has considered one, and it has to be very common. But what they've done is probably take an example of a share of Reliance. So it's an intraday trader. This kept certain shares of Reliance for long term, for 2-3 years, and put it in the investment portfolio. And the same company shares are also traded day in, day out. In such cases also they have held in the favor of the assessee, because the intention of having the same share for trading and for investment was different, and it was specifically brought about by way of books of account. So all of these parameters are very much relevant. The only thing is these circulars, these instructions do not get abided when there is some kind of penny stock or some kind of based on certain investigations or SEBI inquiries, or if you have done certain illiquid share trading or stock options or derivatives. There is a rider into this circular which says that if those are the situations, these circulars or parameters won't apply. However, even after so much of clarification and instruction, we still have it. The only advice is obviously to have a different books of account. But what in a scenario when the assessee has not maintained the different books of accounts? In that case, there is this office memorandum which I have mentioned, which basically helps the assessee. So I just read out certain parameters, just important ones. There are 15 different parameters which have been specified in this office memorandum, which one can decide, and this is an office memorandum as an instruction to the assessing officer, that you have to look into each of these parameters to find out that whether it is share trading or business income. So I think these guidelines are, first, as I mentioned, is intention. Second is what kind of activity it is. It is an incidental activity or it is the prime activity of the assessee. So that is one. Whether you have an intention to make profit or gains. Profit is short term, long term, or gains would be something which you have kept it, parked it aside. Then scale of transaction. One thing is, one word of caution is, none of these parameters individually will work. So it all has to be put together and then looked into. Frequency and continuity of the transaction, and how that has been taken by the assessee year to year. So if an assessing officer in one particular year is allowing that particular script as a long-term asset or a short-term asset, let us leave long-term because long-term have a 12-month period. But if it is a short-term asset, then the second year, the assessing officer cannot say that this is your business income. So there has to be consistency of the view. And other things like, if it's a company, like object of the memorandum of association, the holding period is also very much relevant, and books of account. And lastly, the time devoted by the assessee. If it has to be an investment portfolio, there is not much time involved as compared to a trading portfolio, because there you require attention to detail and time involvement on day-to-day basis. So these are a few things just put together to decide such particular issues. So these are various case scenarios which I have mentioned. I'll just take one or two which is relevant because we have whole presumptive taxation left. So I had one question for joint ownership. There are multiple case laws which I have cited here. I think one parameter which I have come through after reading many case laws is that only if you have joint ownership for namesake with your wife, son, legal heir, minor son, daughter, it is irrelevant. The relevance in joint ownership is only that who has contributed toward purchase of the property. I have purchased, even in a scenario, if I have put 100% of my cost, but the entire flat I have kept in the name of my spouse, then also it will be considered as my house. Because there is a lot of things which is debated in the case laws, that the way Indian tradition works, it normally is that the wife name is first, the husband's name is second, or there is in fact, they have even overridden those cases wherein the agreement they have told that 50-50%. Still, they have told that just by mentioning that it was a stereotype agreement, by just mentioning that you cannot say the intention. It has to go from the bank account of that particular assessee, unless in a very typical case I had read wherein there was a joint bank account of a husband and wife, and there was amount from that, and then there was 50-50. In that case, they considered it as 50-50 because they told that it is a joint bank account and we are not able then to ascertain. So then we will go by the wordings of the agreement which has been signed between the parties. But one standard thing which has to be kept in mind is who has spent the amount. That is the person who gets the deduction, and that is the person who gets to be the owner. And even for the deduction, if suppose if there are cases wherein there are joint ownerships, and especially when we have that one house limit for deductions, or now that we have 2 house limits for the deductions under 54 and 54F. So in that case also, suppose if I am having 2 joint houses, like I am 50% owner in 2 houses, then that will be considered as one house, not 2 different houses. In joint ownership, that also has been led because at the end of the day, it is the ownership which you are looking into. In many cases, the assessee have used it in their favor, that it is in name of my son, it is not in my name. I might have paid the amount because it's a minor son and minor son cannot pay, so it is that particular property is not mine, and that is why I have only one residential property. There also they have not considered it. And these joint ownership things will also help in cases of claiming of exemption under 1013A and for HRA purposes, wherein they say that I do not have a property on my own and I'm rented out somewhere else, because there are a lot of, now they are adding back all those deductions which you are claiming. But if you so remember, if you have purchased a property in name of your wife, but still it is your own property. Yes.
What about if you have gifted the property?
So if you have gifted the property by way of a gift deed, then it is not your property, then it is the property of the person who is receiving it. Yes. Yes.
Yes, for example, you have given the example. Then it will be applied.
I think it should, because at the end of the day, all of those are capital assets.
This
Yes.
is a purchase in case of purchase of property. Last year we have just in the transfer.
Yes, yes. Society transfers are not relevant. So I'll probably skip the queries if we have time. So, and we move on. And I want to start with presumptive. I think I've eaten up a lot of time with capital gains, but yes, presumptive taxation has a lot of queries. What I'll try to do is that since we have less of time, I'll try to answer the queries which I have given here, so that we get an overall perspective. So this is a simpliciter case of a doctor who has 2 incomes. One is an income from sale of pharmacy and second is consultancy. Now we have 2 provisions, 44 AD and ADA. AD is for business and 44 AD is for professions, listed under section 44 AA1. So doctor is one of the professions which is listed. So in this case, what does an assessee do? Does it club everything as 44 ADA? If he does that, then he is out of the limit, because 44 ADA limit is 50 lakhs. So in this case, the question is where they can show the income. According to me, the income has to be shown in section 44 ADA, as it is a professional who is listed under 44 AA1. So consultancy income of 40 lakhs will be under presumptive taxation under 44 ADA. However, it is a view, and it is a very, I think, view of most of the people whom I have deliberated with, that one cannot claim deduction and one cannot claim presumptive taxation reliefs under both the sections simultaneously. There are certain views where people say that you can do it, but if you read the language of section 44 AD, there is a provision, subsection 6 of section 44 AD, which specifically, it is an exception which says that all those professionals who are listed under section 44 AA1, they cannot claim this, but they cannot come into, they are not eligible assessee. In short, 44 AD works on eligible assessee and eligible business. So if you are not an eligible assessee, that is my next question, that whether 44 AD is qua assessee or qua income. According to me, if you read that subsection 6, it removes the assessee itself, and that is why it is qua assessee, not income. And that means that if I am a person who is doing a profession under 44 AA1, then I go outside the ambit of business section 44 AD. And once I get outside because of that parameter, although there is nothing in 44 ADA of similar sort, but I think it is enough that it is there in one section, and that means the intention is to exclude those kind of professions from entering into that business. And in fact, that particular subsection came way before 44 ADA was introduced. And so I would say the intention is very clear that one cannot claim, one cannot say that for 1.2 crores, I will claim 8% of profit. For 40 lakhs, I will claim 50% of profit. You cannot do that. 1.2 crores will fall under the 44 AB category, which is the normal tax audit category. It will be considered as business because it is a sale of pharmacy, but it will not be considered as eligible business for the purpose of section 44 AD. So this is the view which I have in fact, it pertains to a lot of case studies in the next scenario. Now, the question is that can one choose, suppose 1.2 crores is my predominant amount. Can I say that, look, I do not want to claim 44 AD. I just want to claim 44 AD. Given that now I can do only one, so I want to claim 8% of 1.2 crores under 44 AD and let this be under normal route of profession. Think still you cannot do that. This goes into another fundamental question, which I have taken up it in the next slide, but I'll discuss here, is that whether presumptive sections are mandatory or are they optional. So yes, the views are just like this audience. If you ask me, from the way the language has been drafted, it looks to be mandatory. But if you ask me logically whether it should be mandatory, I think it should not be, for the reason that it is unfair. If you are giving certain beneficial provisions, you need to make it optional. It's like we have we have options whether we want to claim deductions or whether we don't want to claim deductions if I'm a salaried employee. So I do have an option there. So presumptive should not be made mandatory, but the way the sections have been drafted, 44 AD and AD, both, they continue to use the word shall everywhere. And that is one of the reasons why it feels that it is considered to be mandatory. And in fact, the section 44 AD and ADA both have received constitutional finality. So both the sections are constitutional. And if one reads the order wherein the constitutionality has been finalized, from the reading of the order also, it seems that the intention is to make the presumptive sections mandatory. And if it is mandatory, if I conclude that it is mandatory, then I really do not have an option that whether it is 44 AD or 44 ADA. If I am a professional who is listed in the qualifications under 44 AA1, then by default, I will have to take 44 ADA only. I cannot take the 8%, 6% benefit under section 44 AD. So this gets into that there are cases wherein there is one case of tribunal. I was trying to search that yesterday, but I couldn't get it, wherein it has been held that it is optional. There is one tribunal case. If I'm not wrong, it is Pune or Indore tribunal. But at the end of the day, it's a tribunal decision, and this is a question which is beyond. It's a legal question basically to enter into. But the majority of you, which I've got to talking to a lot of seniors also, people who've written books on presumptive, is that it is mandatory. So going with that, then the assessee does not have an option to choose. And will the answer differ if she is not a qualified doctor but a B.Pharm graduate? So like we have a lot of tax consultants who are not CA but they do taxation work. There are a lot of B.Pharm graduates who along with pharmacy give consultancy. So in that case, the answer will differ. Yes, definitely, because 44AA1 is driven by qualifications. So for you to be a doctor, you need to be a chartered accountant. You have to have that degree. For you to be a software engineer, you have to have that degree. So if you have qualification, if you have experience, but you do not have that qualification which fits into 44AA1, then you have obviously do not fall into 44ADA. And since you do not fall into 44ADA, all of your pharmacy sales, you can claim it under presumptive taxation under 8% or 6%. So it all also differs. Again, I will say TDS is compliance. I understand. See, now what happens is, no, because of this presumptive taxation, no, we have three categories. Earlier we had business and profession. Now we have three categories: business, profession not under 44AA1, and profession which is under 44AA1. Now, because the profession is under that, in fact, that is a very important question which I have taken up in the other case study, that I am a professional, but I do not have the qualification. But I'm still exercising a profession, and there are cases in the past which have decided what is business, what is profession. We have Supreme Court decisions also, and profession by definition has a vocation. So it is not for, it has to be a use of some skill, wherein here it is the use of the skill. So now, and 44AD talks about eligible business. So there is always a question that if I'm not a listed profession, do I become a business under 44AD? That is also a question which always crops up in the mind. The answer to that question is that the exceptions of 44AD just is exception towards the qualified professionals and not to all the professionals. And we have Supreme Court case laws which also says that business and profession has to be interchangeably used. Though you have decisions which says that both are two different things, but at the same time, since it is a very subjective terminology, there is a very thin line of distinction what you will consider it as profession and what you will consider it business. You might say that I'm doing the business of pharmacy, I'm a chemist. Then it should be, although I have a B.Pharm degree, I'm professionally qualified with another degree, but still I'm doing that. Consultancy is also my business. So there are many cases where it is considered as business. So there are people who take 44AD, and we have seen that they have not, up till now, it is not come into litigation that you cannot do that. Probably we might get such questions in the future. So yes, this is basically, there are two questions which I'll address here. This is regarding the turnovers. Yeah, I'll take another 10 minutes if you could extend the break. I'll try to complete it. Too ambitious, but I'll try to complete it. Yes, please. I'll eat up all his break and the time, everything. Thank you so much. I'll just complete in 10 minutes. So here the question is, you probably could read the case study later on, but I'll talk about the anomaly which is created because of multiple turnovers. So there is one turnover which is 1 crore turnover, which is under 44AB, which doesn't talk about the cash receipts. So if you have aggregate cash receipts or payments, more than 5%, then you have a turnover limit of 1 crore. If presumptive taxation gives a limit of 2 crores, that if you have a turnover up to 2 crores, then you fall into that. There is this third limit, which is 10 crore limits, which has been recently amended from 5 to 10, which says that if you have less than 5% of cash aggregate, then you have 10 crores limit. So the question is that when you are claiming that 44 AD has that limit of 8% and 6%. So suppose, considering a case that I am a person who is having a turnover between 2 to 10 crores and I want to claim 4% of profit, okay, which is less than 6% and 8%, because presumptive taxation doesn't apply to me because my turnover is beyond 2 crores. Even if I do that, even if I claim a loss, I'm still okay to not do tax audit. But if I'm a person who is under presumptive taxation and I show a turnover, a profit of 4%, by default under section 44 AB subclause E, I have to do tax audit because I'm showing a profit lesser than what is shown under presumptive taxation. So in such cases, presumptive taxation, the people who are under 2 crores are disadvantaged because of the beneficial provisions. This is just the anomaly which I wanted to bring about. And another question is regarding TDS, that whether assessees who are under presumptive taxation, whether they are required to deduct TDS or not. So this also links into with the disallowances made under 40, wherein you do not pay TDS, or there are certain expenses which are disallowed if you do not deduct TDS. There are two distinct questions here. One is that whether section 40 AIA applies to person who is eligible assessee under presumptive. There are multiple tribunal decisions which have stated that presumptive are notwithstanding provisions. They say notwithstanding anything under section 28 to 43C. So that also includes 40 AIA. And that means that if I'm not deducting any TDS, it doesn't mean that the expenditure will be added back under 40 AIA. That is very clear by tribunal decisions. But TDS liabilities and compliance is a different provision altogether. That is a compliance provision. So just because one has to not join it together, and answer is that the presumptive taxation person also has to deduct tax at source, because there are repercussions of non-deducting tax and non-paying tax under TDS provisions. So just because you are under presumptive provision doesn't mean that you do not deduct tax at source. You might not get attracted by 40 AIA, but still the deduction has to be done. There are two views into this, but just giving a disclaimer here. Sorry? I'll come to that. I'll take one line on that. So this is not, yes, sorry.
Just
Yes.
because the turnover was the same.
Correct. Now they have delinked it. Correct. Correct. Now they have delinked. Now coming to this mandatory part, which I have already talked about, but this is an often question which has been asked, that if you have a loss from FNO, do you by default come under presumptive and will you have to do tax audit? So this is the question which is normally asked. So here again, the question is that the section subsection 4 of 4480, which says that situations in which you will have to do tax audit. It says two things. One is that you are an eligible assessee having a loss income from eligible business, and you are claiming presumptive taxation provisions, and you are showing a profit less than 8 or 6%, which is obviously a loss in your case. So that condition is satisfied, and you have income which is less than maximum marginal limit. So if you are an assessee who has both of it, you have a loss and you have an income which is less than, you're not paying any taxes, whether in such cases, in such simpliciter cases, you will have to do tax audit or not. There are two views. I will be very frank on this, whether you will have to do or not. The people who consider that presumptive taxation provisions are mandatory, they say that, see, look, 44AD applies to you because your turnover is less than 2 crores and you have a loss and you're not showing 6%. And you also get those intimations by CPC. If you don't do tax audit, you start getting notices. They had started issuing last year. So that is one point of view. Second point of view is, which is more technical. If we read the subsection 4, it says eligible assessee who is claiming or who is using the presumptive taxation. So suppose if I have never used presumptive taxation in the past, then I do not fall into that. And if I this 44AD applicable to you just because you have a loss. If you ask me, the answer is no, because if you have to read very specifically, and that is why you need not do tax audit. But despite that, you might get notices from CPC and you might have to fight legally. But there are many people who sumo to 6% dikha dete, 8% dikha dete, so you don't have to get into trouble. So there are people who show 8% and do it. That is another practical option which people do it. But if you want to take a legal stand, I think this could be one technical stand which one could take. But in case of income more than, then that subsection doesn't apply to you. So that's because it says very specifically and, the word used is and. So you have to fulfill both the criteria to do the tax audit under subclause E. It is not only the loss. So if you read it very carefully, you should have, so that is the question which is, in fact, the reason this assessee is a partnership firm is that only. Because partnership firms do not have a basic exemption limit. So in that case, what will you do? Exactly. So in that case, this seems to be a kind of loophole to me, because partnership firms, they do not have any basic exemption limit, and the section specifically says that you need to have that maximum margin limit. It takes away the purpose of subsection 4, and then according to me, for a partnership firm, tax audit is not required, because if you go very strictly by the language, not by the intent, then you go away, because that seems to be one. There are many loopholes in the way they have drafted the sections, both the sections. So this could be one of them. That is the reason I made the assessee partnership firm here. So that even so, in that case, if you're paying, if you are there, it is very clear. If you are not below the maximum marginal limit and you are paying taxes on some other income, you're not, because that condition doesn't get bridged. The earlier section was different. There, there was only one standalone thing, that the moment you show the lesser one, the lesser profit, you have to do tax audit. But they have complicated when they substituted the subsection 4 and 5. So because of doing that, they missed on this point. F&O loss. You don't need to do tax audit. I feel you should, anyways, even if there is no side, because if the person is never claiming it and just having it, still I think it should not be having doing a tax audit. So yes, and okay, I think I'll take this last one, and then probably we could wrap up. Since it is all related to us. So practicing chartered accountant, again, this is like a doctor thing, but little different. Here you are practicing and you're also teaching, and you're teaching not as a salaried employee, because obviously you're not allowed to be a salaried employee if you're practicing CA. So you are getting it on a contract basis. You could consider yourself as a guest speaker. There are many guest speakers in various colleges. So you receive from both. Now here, the difference from the medical profession is outright sale of pharmacy. Here it is not sale. Here it is use of my expertise. So here both of it is my professional income. It cannot be considered as business or professional. So in this case, do I need to add 30 plus 15 for my 44 ADA or just my consultancy? So there have been cases in the past, again, all tribunal level cases, so we cannot have much precedence on that. But one thing which they clarify is that when they speak about 44 ADA or 44 AA1, it has to be professional services in exercise of profession. So suppose if, would your answer differ if I am a chartered accountant, but I am giving other services which I'm not exercising in the profession, but suppose if I'm doing something very different, which is not related to my practice, then in that case, still would you consider it just because I'm qualified chartered accountant? The answer will be no, because it is not in exercise of my profession. So now I would like to agree to the view of everyone here. You should add it only if, suppose if I'm teaching something like tax, I'm teaching something like economics, accounts. Suppose if I'm teaching art, then it is not an exercise of my profession, although it is teaching. So then, although it is out of my skill and ability, but it will not be in exercise of my profession. The subjects which are in exercise of my profession are the standard subjects under chartered accountancy course. So then you probably have to look into the facts of each case. But this would be, I think, the rationale, but we need to add in. And there's a classic controversy which is created because of two decisions in the latest past. One is Madras High Court decision in 2021. And I think another one is 2022 Bombay High Court decision. Now, why I would like to specify here is because these two decisions are very disturbing. We have Supreme Court decision in case of Ramniklal Kothari, which says that partner and partnership firm both are considered to be having the same business. It is just a different constitution, but partner and partnership firm both are same. We have Supreme Court decision for that. That means because of that, it justifies section 28(4), which says that remuneration which I receive from a partnership firm or interest which I receive should be considered as business income of the partner, because I am doing business. Ideally, interest is income from other sources, remuneration is salary, but still it is considered under 28 because of this Supreme Court decision and of the law which is there. Now the question is that when I'm showing I'm a partner in a partnership firm, and the partnership firm is a, suppose take a CA firm, I'm a partner in a CA firm, then will I be considered as a person who is exercising profession? The answer is yes. The High Court judgment of Madras and Bombay says that for presumptive purposes, the partner is doing the profession, the partnership firm is doing the profession, the partner is not doing the profession. This is the rationale of when the Madras High Court judgment came. I probably thought that is one of the judgments, but Bombay High Court has relied on Madras High Court decision in 2022. In March, we have received this judgment. Unfortunately, it's a jurisdictional judgment and we have to follow. But when you see the irony here, the question is that if you say that, and in these cases were regarding 44 ADA. So they say that partnership firm is eligible for 44 ADA. So partnership firm can claim 50%, but the partner cannot claim 50%. Now most of them would be doing that. Most of them would be claiming under 44 ADA. And this probably shakes the entire basis of 44 ADA. But since it's a High Court decision, I just wanted to point it out. People might, for this year return of income, people might still do it. But if you have to follow this decision, then probably you might not be able to claim, even though if you're a partner in a partnership firm, you might not be able to consider it as a business or you cannot be considered as professional receipts. So what they say is that if you are, so suppose if I was a proprietor, then proprietary income I will consider under 44 ADA. But whatever remuneration which I am receiving as a partner, that cannot be included in gross receipts for the payment of 50 lakhs. That is what this judgment is saying. So it puts an irony to the Supreme Court decisions in the past.
Then the tax audit also will be applicable.
it will, yes, it will depend. The tax audit will also depend upon that. So yes, it will all depend upon that. Yes, it could be. And I think, yes, I have covered 40 AIA. Yes. I'm just seeing if I'm want to take anything. Yeah, please.
So, for example, business gave me 44 and as for 44 you don't need to make.
So, not maintaining books of accounts is different from the actual transactions which are happening. You might not maintain books of accounts because of the law which you have, but whatever actually the transaction, if you are passing on a remuneration, you through your bank account, which is a legitimate transaction, the transaction cannot be overridden by the legal provisions. It's just you are taking the help of the legal provision to not maintain books of accounts. In fact, that is the last thing which I wanted to discuss is the additions which are made under section 68, 69, 69, that whether under presumptive provisions you are not required to maintain books of accounts. Now, section 68 and 69, 69A, they both require books of accounts. However, section 69A says that there is no requirement. So there have been cases where the assessing officers have not added under 68, 69, but they've added under another section where it is just to meet the, the literature which is given in the Income Tax Act. But in such cases, what the cases have been that only that in such scenario, can the assessing officer say that I reject your books of accounts, because rejection is required when you make an addition under these sections. So there is always a dilemma that there is no books of accounts. So there have been a lining which has been bifurcated. If I am not required to maintain books of accounts and I have not maintained books of accounts, then there could be no addition under section 68. But if I'm not required to maintain, still I have maintained for my own purpose, then the assessing officer, if he finds that out, he can reject that books of accounts and say that it is done. Another thing is that if you have claimed 8%, okay, there is, people feel that 8% rate is blanket rate, but the section says 8% or higher. So if you claim 8%, there are many people who say that you have to take 8%. I am of the view that you have to take higher. So if you show 8%, that means you are showing that you have an expenditure or withdrawals of 92%. And if in the bank account, there's not a single withdrawal, or if you have purchased a flat, recently, how are you going to substantiate that investment? They are going to definitely add that under section 69 saying, correct, but that is all tribunal level decisions. And what it says, when the sections 44 AD and ADA, they are not withstanding only up to 43, not 68, 69. And that is a different, what it says is that at the end of the day, if what they do is they don't talk about books of accounts, they just straight away get into the fact you have purchased a property. No, show me the source. You are telling that 8% is your profit. That means 92% is an expenditure. So how come you have that much of source? The moment you say that I have source, that means you have profits. That means you have shown lesser profits under presumptive and you have misused the provisions of 44 AD. The entire reason of 44 AD, if you go back to, was for civil contractors and all those people, or grocery shoppers who do not maintain books of accounts. They don't know, now everyone obviously have digital wallets and everything, so you still can determine your turnover or determine your expenditure. But if people who are totally doing business in cash and they don't know, and they are small traders, the entire reason was to that. But if the moment they know that you are misusing the provision, they might not do any addition here, but they might say that the source is not explained and I am adding under 69, and no one can stop them to do that. Yes. There are cases, but at the end of the day, they are tribunal. If they travel to high court for some or the other reason, then probably we can.
Flat is not purchased, but the care amount is kept in bank account.
Then probably they might not question, because source is questioned of an asset. So, but if they want to get into the provisions of 44 AD, then probably they can still get into, because the language says higher. So they says that you know the onus is on you to say that it is not higher. So you show me how it is not higher. Then if you don't explain it, then they probably can tell you to show a higher percentage.
Books of accounts, so I don't know.
They will add turnover percentage, any percentage of your turnover. In many cases, the bank account entries are considered as books of accounts. Although those are in case of 68 and all those things and search and seizure cases, but they can use those cases here. So, yes. 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 Yes.
More than 8%.
Okay. You are getting notices in such cases by CPC right now, unfortunately, that your turnover is less than 2 crores, so you have to have under presumptive. What they are getting is that in that ITR form, you have that dedicated section. So you have not showed in there, but no mismatch they will show. Otherwise, there is no problem as such. There is no addition which is going to be made to you. I don't think so. Any tax liability coming on you. Yes. I have to I've gotten 3 ultimatums. Thank you so much. Thank you so much.
Thank you. Thank you, Kinjal. Just a formal vote of thanks on behalf of the JB Nagar CP Study Circle. I would like to first of all acknowledge all your efforts that you put in compiling the presentation. You very well discussed all the case laws with the relevant case laws, the sections, the circulars, instructions and all. Thank you for taking up all the queries of all the participants and the way they've been pinned up to their seats and not getting a further break. It shows us that they would like to hear from you again for a longer duration. We'll keep. Thank you so much, Kinjal. Thank you for the coordinators for helping us out today. Yes, we will definitely have more sessions from her. One more announcement: we have taxman people here on demand by the participants last time. He's here with all his books and he's offering great discounts. So you are all requested to check out his stall also. We'll break for a short break this time. I think we'll get back in 10 to 15 minutes and then start with the second session. Thank you all.